Good morning and welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. It is Wednesday, February 8th. I'm Katherine Ross, filling in for JD Durkin. We're about 30 minutes into the trading session, and would you look at that, the Dow is essentially flat while both the Nasdaq and S&P are trading lower as investors digest comments from Fed Chair Jerome Powell and a flurry of big earnings reports. On the show this morning, we'll preview Disney's first quarter results as the company gears up to release earnings after the bell today. Plus, we'll dig into the latest from big tech as Google and Microsoft fight for AI supremacy. And finally, we'll recap Uber's fourth quarter report as ride revenue surges. For more on these stories and so much more, let's welcome our senior editor and chief markets correspondent, Martin Baccardax. Martin, as I said, the Dow is essentially flat while the Nasdaq and S&P are lower. What's driving investor sentiment this morning?
Well, I'm interested to see what sort of momentum yesterday's rally is going to carry into today's session, Catherine. It is quite early, and I think we have seen that the pre-market and early market trading isn't always a diktat with respect to what we can expect throughout the whole of the session. But I do think that last night's rally was significant for a couple of reasons. The first and foremost is we really sort of have a firmer understanding now of where the Fed stands with regards to its inflation forecasting, where it sees interest rates rising to, and to what impact the job market will have on their reaction function. Essentially, Powell, during that question and answer session yesterday at the Economic Club of Washington, D.C., said, the job market is very strong. We were surprised by the January gain, but it didn't suggest that it was going to have any meaningful change in their forecasting. They're looking at a rate hike in March and then a follow-on hike in May. And then they're going to survey the landscape with respect to inflation, growth, and employment data to understand where they go next. Now, he caveated that on both sides, Catherine. He said he sees inflation slowing significantly this year, but he said if it were surprise to the upside, they could raise rates even further. So I think it was a balanced interpretation of the economy and the job market. It didn't provide investors with anything different from the signaling that he had given them last week, both in terms of the Fed decision and the press conference that followed. And as a result, you had a downward trend in bond yields and a significant uptick in stock prices, which really just accelerated that rally that we have been seeing over the past few weeks.
But Martin, would you argue that maybe we need to see the market action today in order to call yesterday's action significant? Because we do have 3 Fed speakers on tap today. So we I would imagine that investors need to digest whether or not they agree with what we heard from Powell yesterday, right?
I think you're absolutely right, Catherine. I think in order to consolidate yesterday's rally, investors are going to want to find out whether there's any dissension with respect to Powell's assessment yesterday. And if there is not, then they can comfortably accelerate some of the gains that we saw as a result of that. John Williams is probably the most significant of the speakers. He's the New York Fed president. He's very unlikely to deviate from what Powell has said, but we have noticed in the past that certain Fed governors and certain Fed presidents have differing views to the chairman, and they do tend to leak out, and I don't mean leak in the bad sense, I mean leak in the public sense, from time to time. But I think if the markets can navigate today without any particular significance in terms of a differing in opinion from the Fed speakers that we have in the field, and I think it's about 8 or 9, if I'm not mistaken, then that rally can absolutely be consolidated. But I think you're right to note that there is a little bit of caution with regards to yesterday's movements. But again, if it is given that kind of validation from the Fed speakers today, then there's every chance it could accelerate into the end of the week.
Let's just say that today's action isn't necessarily what we want to see, right, Martin? And if that happens, do you think, we've kind of been dancing around this question all week, do you think that if we lose the momentum on this rally, our luck is starting to run out for a rally throughout this year? Do you think we're going to be less strong going into next month?
I think it puts the rally at least a little bit more firmly in question, without doubt, Catherine, because I think there is a great debate as to whether this is fundamental or sentiment driven. What I would imagine might happen is that investors will like to see what the big retailers are saying with regards to not only their January quarter earnings, but what they see in terms of spending patterns going into the first half of the year. This is going to be a consumer-driven economy. That is beyond dispute. And that's largely because the job market has remained so resilient, even in the face of the layoff announcements that keep coming from the tech sector. So what retail has to say about spending is going to be incredibly important. What we see with respect to the housing market is also going to be important. And both of those are going to point to whether we can rely on that labor market resilience to carry over into the first half of the year. If those things dovetail together, Katherine, then you could plausibly argue that the sentiment rally is suddenly going to be underpinned by fundamentals. And if that's so, it has more legs. If retail is a little bit more gloomy or pessimistic about the near term, then you could absolutely see investors taking some money off the table as a result.
Martin, I'm curious if yesterday you thought that we saw any kind of tone shift from Powell, or was it essentially the same tone that we heard on Wednesday? I mean, he did say disinflation 15 times.
Yeah, I really felt he was quite relaxed and almost sanguine, Katherine, during the question and answer session. That may speak more to the format. It was generally a little bit more informal than it typically is, where he's making a prepared speech or even taking questions from the audience. This was a back and forth that touched upon a whole host of issues, including his annual salary, which he got wrong, by the way, by about $15,000 a year. It must be nice to have that kind of margin of error in your spending, but that's a different discussion altogether. But I do think his tone was largely relaxed as a result of the format, and also with respect to what he is seeing in the market and in the U.S. economy. Katherine, we really are on our way to a very interesting landing for the U.S. economy. Whether it's soft or hard is another debate. But I think it's beyond dispute now that we are going to avoid recession, at least in the near term. It's possibly very likely in the medium term, but certainly not anything that's going to materialize between now and the end of the summertime. GDP Now forecasting tool suggests we're growing at about a 2.1% clip. The job market, as discussed, is incredibly resilient. And if that can filter through into consumer spending, then the growth trajectory is going to be maintained. And it's going to get further support from the China reopening. So all of that said, and all of that being so, I think the Fed chairman was relaxed in the sense that he can see that developing whilst not seeing any great spikes in inflation on the horizon. He talked about that significant decline, and as you alluded to, he mentioned disinflationary pressures 15 times in his statement last week. If he is able to engineer or thread that needle where he can get solid economic growth with slowing inflation, well, he's likely to be canonized, I think, by financial markets for that sort of effort. And that will be an incredibly different sort of perspective compared to the criticisms that he took at the latter part of 2021 when he described inflation as transitory, when it turned out to be anything but.
I appreciate that you are just fact-checking our Fed chair. To continue on with what he said yesterday, Martin, he was also very much in line with what we heard from Kashkari and Bostic yesterday morning, with both of them saying that this is not as smooth. With the jobs report, it wasn't as smooth as they wanted. Powell said directly, and I'm quoting him, this process is not going to be as smooth. What do you make of that comment? Is that something to expect from him?
Yes, I think so. I mean, ultimately, Katherine, and there has been some criticism with respect to this focus, but the Fed has been very much focused on the wage price spiral and the pressures that it brings towards inflation within the U.S. economy, and more specifically, inflation that's embedded in the services sector, ex-housing. Now, you could argue that the Fed has largely isolated housing inflation by lifting interest rates and therefore creating a big jump in mortgage costs, which has tamed buying, tamed selling, and really cooled that market quite significantly. That's been evident in housing data for a number of months now. But the big January jobs gain has just sort of shaken their confidence a little bit that they can bring down inflation in the services sector, ex-housing, because it's so tightly related to the job market. They're seeing it in goods. That's, again, beyond dispute, and it's something that most Fed policymakers have essentially conceded. But they're not seeing it to the degree that they would like in services, again, because of its tight correlation to a very tight labor market. So I'm not surprised by that commentary, but I don't necessarily think that it's going to prove true. I think this jobs market is just maneuvering in a dynamic that is unprecedented in history. mostly, and well, I say mostly, I would say almost entirely the result of the disruption that we have that we had through the COVID pandemic and the changing habits and the changing work patterns and the fact that a lot of people just left the market permanently as a result of a whole host of factors. So the traditional application of the Fed reaction function on the job market may not apply now. In other words, it's different this time. And if that is so, then the market might be correct in assuming a lower Fed funds rate and possibly even Fed rate cuts at the back half of the year. The Fed isn't buying that just now, and that's, I think, why, Katherine, they are stressing that they will be able to move higher if needed because they are so focused on that job market.
Martin, I'm going to out us both as nerds right now because we both keep a close eye on the CME FedWatch tool. Earlier this week, meaning Monday, we saw it as high as 96% of sentiment towards 25 basis point hike. Now I'm seeing 90%, so it's lowered a little bit. Do you think that Tuesday's interview and the comments that we've heard so far from Fed presidents has given us a clue on how the Fed will act in its next meeting?
That seems to me a little bit more related to what we're seeing in the Treasury market as opposed to what investors truly believe is going to happen in the March meeting. I think that 25 basis point rate hike is locked in, absent any sort of disaster between now and then. And we certainly hope that we don't get it. But I think, Katherine, what is more sort of interesting to me is the fact that the second 25 basis point rate hike in this cycle for 2023 at least, which will be the 10th in succession, is being priced in for the May meeting. That is now over a 70% probability when we were looking at numbers in the high 30s only a couple of weeks ago. So the bond market has come around to some degree to the Fed's thinking and is at least begrudgingly assuming that the Fed is going to get that terminal rate to 5% and perhaps a little bit above. There's still some debate over what happens in the back half of the year, and that's perfectly understandable because there's a lot of data to plow through between now and then. But the bond market has sort of acquiesced in its fight against the Fed, whereas the stock market hasn't. It's still trying to climb higher, even in the face of these sort of overarching warnings about a higher Fed funds rate that should, in theory, keep stock prices down. But it hasn't so far this year. So it's interesting to me that we're seeing that shift in fight to some degree away from bonds and into stocks.
Well, while we know that the Fed is really the driving force for the market right now, we do have economic data out tomorrow. The weekly jobless claims are coming out. The previous reading did mark a 9-month low. Do you expect these claims to go any lower?
It'll be interesting to see how they blend in with the momentum of the job creation in the month of January. I think that the interpretation is that they will continue to tick down just a little bit. But it's interesting to see to what extent we will see the tech layoffs find their way into the jobless claims figures. I mean, there's still a very small portion of the overall sort of employment base in the U.S. economy, but nonetheless, we're seeing them pretty much on a day-to-day basis. And we're seeing them, of course, in other industries as well. We may see them from Disney tonight, but Boeing has talked about cutting jobs. And obviously eBay last night and a bunch of other tech companies have been paring headcount. So that is going to find its way into the jobless claims data. It just might not be now. But what's interesting is whether or not that momentum from the layoff perspective comes sooner rather than later, and whether or not the momentum from the job creation in January can carry over into February. So it puts these weekly readings in sharp perspective. And the markets, which typically didn't pay a great deal of attention to them in the past, are certainly finding themselves tracking it on a weekly basis because, again, the Fed is so focused on the labor market for its interest rate reaction function.
You mentioned Disney. Let's turn our attention there. It is set to report earnings after market close today, as I said at the top of the show. What are you anticipating from this report?
This is going to be an interesting one, Katherine, because Disney is not only trying to sort of wean itself off of a growth-focused strategy over the past few years in terms of expanding its base in digital streaming, but it's also trying to fend off an activist challenge from Nelson Peltz. Peltz is trying to get a seat on the board. He's going to lobby shareholders to support that at the annual general meeting in April. But at the same time, he is sort of criticizing the company for that growth perspective. He wants them to get a hold of costs. He wants them to align executive pay to stock performance. And he wants the company to do a couple of things in terms of merger and acquisition activity that Disney has pushed back on, at least over the past few months. So it will be very interesting for me to see how Disney sort of puts these earnings into that prism. In other words, can they tell shareholders that they are now getting their arms around costs, that they're on a path to profitability in the direct-to-consumer business, and that they have some M&A in plan in order to sort of fight off the challenge that they're seeing from Peltz. And it has to be said, some other activists who are waiting in the wings, Dan Loeb being another name which pressured the company to make changes in the summer of 2022. So that sort of that overarching narrative will find itself clashing, I think, to some degree today, Katherine, because Disney wants to get profitable, but at the same time, some of the most important investors are running out of patience.
You mentioned profitability, which is obviously a key factor in this report. And when you're keeping in mind the activist pressure that Disney has been under, as well as the fact that this is Iger's first time back in the helm for an earnings call, what are some of the most important factors to you in this report?
I think it's going to be twofold, Katherine. I think the first is going to be to what degree the Parks and Experiences division is going to hold up both the top and bottom line for the company. Parks and Experiences has been doing incredibly well. It's actually delivering the bulk of operating income and indeed revenue gains for Disney, and that's likely to carry on. We're seeing all sorts of suggestions that the travel boom is ongoing and will continue well into the first half of the year. And that, of course, only indicates that people are going to be taking these big, expensive trips to the theme parks that are dotted all around the world. China is reopening, and that's good news for Disney Shanghai, and that is certainly going to be a driver of both revenue and operating income growth at the same time. Orlando International Airport, Katherine, is actually looking at data that suggests its traffic is going to be close to the pre-pandemic record, and that indicates, of course, that people are flying into Florida for vacations, which, of course, will bring many of them to Disney World in the suburbs of that central Florida city. So lots of very significant data points suggest that the Parks and Experiences division is going to do quite well. The flip side is whether or not direct-to-consumer is still going to have to swallow a lot of red ink as it attempts to not only fend off the Netflix challenge, but simply align its cost structure to the scaling that has been going, that has been underway for a number of years now. That direct-to-consumer division lost $1.5 billion in the fourth quarter of last year. So that red ink has to be tamed. We'll look for that very significantly, of course. And to what degree taming that red ink is going to suggest slower subscriber growth. So we might get a muted outlook on digital subscriber growth for Disney going forward, but investors might see that as positive, perversely, because it indicates that Disney isn't trying to chase those gains whilst operating on a lost leadership basis, and they're actually trying to pare those costs down. And that, of course, will at least assuage some of the concerns that investors, particularly at the activist end, have had.
For the past, I'm going to say about 6 months, I've had numerous conversations with investors in Disney, and one of the biggest gripes that they've had is that the quarterly earnings reports have been very much driven by those Disney Plus numbers. Do you think this is one of the first earnings reports that there's enough noise going around outside of Disney Plus that won't be a focal point?
I think it will still be incredibly important. I think there's still some transition going on that puts it in stark focus. Obviously, Disney has launched the ad-supported platform. Netflix did the same. So investors are going to be looking at how exactly the ad spending market is going to buttress the lower subscriber cost that is linked, of course, with an ad-supported tier. In other words, are subscribers going to shift from the more expensive to the cheaper version, and can that switch be offset by ad spending? Virtually everybody in the digital ad space is telling us that companies are pulling back on the marketing spend, and it can't be relied upon to grow at the same levels it has in the past. So Disney is going to have a detailed explanation about that transition in much the way that Netflix did as well. And again, their near-term expectations about subscriber growth, particularly in some of the low-margin markets such as India, are going to be very important for investors to get a better understanding of how quickly the direct-to-consumer business can return to profitability. And that may take some time. Disney said it will take over a year when it gave fourth quarter earnings in November, and that might prove again to be the case. So they're not sort of ready to completely jettison the over-focus on streaming just yet, Catherine, but I think they would prefer to switch the conversation to that Parks and Experiences division because it's just been going gangbusters and will likely continue to do so.
I mean, there are some Disney bulls that would also like that. Martin, there's obviously no way to tell what Iger is going to say on that conference call later today, but what do you want to hear from him?
I think the most interesting nugget that we could get, and I don't think we will, but it might be fun if so, is what the company has to say with regards to the 1/3 stake in Hulu, the streaming service, that it doesn't already own. Comcast is holding on to that stake. Disney has to make a move to buy it by January of next year, and Peltz has been pushing for that sale for a number of months now. Now, there's been all sorts of reporting suggesting it might come sooner. There's been many others who say it won't come until the final deadline in January 2024. But it would be very interesting for me if Iger were to give a definitive sort of statement with respect to what Disney wants to do, what they're prepared to pay, and what that will bring to the bottom line. So if there is anything to come from this beyond the guidance, it will probably be that. What is Disney's ambition ultimately with Hulu, and to what will they have to pay to get Comcast out of the way?
Zooming out to the larger earnings landscape, while close to 70% of companies have beat on earnings in Q4, this is below the 5-year average of 77%. Yeah. What's behind that decline?
I think a lot of it is consumer spending, Catherine. I think to some degree, we are seeing that pullback, not only at the end of last year, but the anticipated pullback into the first few months of this year. And I think that has implicated, at least to some degree, the muted, not only earnings beats, but the outlooks that we've been seeing. It's not as pronounced in some of the other sectors, but tech has seen it for sure. And I think as well, particularly in some of the mega cap techs, they have talked about the fact that, as I alluded to earlier, marketing and digital ad spending is on a pullback as a result of the macro uncertainty. And we're seeing companies pull back on a lot of the spending that they would normally divert to their business expansion. In other words, maybe taking data into the cloud, adding more, how do I want to describe this? Adding more staff, and therefore, as a result, having to buy more software and services from companies such as Microsoft and Google and others. So business spending on a pullback, consumers tightening their belts, probably were the two most significant contributors to, I think, what has been a relatively, not a terrible, but a disappointing earnings season.
Let's take a look at Microsoft now, because we just cannot escape the artificial intelligence push. Microsoft introduced an OpenAI-powered Bing search engine on Tuesday. What do we know so far?
This is really interesting. It's astonishing to me the way that investor-focused 2 AI has accelerated really over a number of months. The technology has been kicking around for a long time, and companies have been trying to get investor attention for its potential to drive search growth and sort of embed into all sorts of products across the whole of the suite, not only for Microsoft, but for Google and Amazon and a whole host of other companies. So it's curious to me that only now does it seem to be getting investor traction, but it's absolutely the case at the moment. Microsoft unveiling yesterday, as you say, the revamp of its Edge web browser and its Bing search engine. It's going to be powered by this new AI and this sort of revived Chat GTP. Now, they say that because of its operability, they're going to be able to grow significantly their share of the search market. Now, the digital ad market is worth about $500 billion a year. and it's absolutely dominated, at least at this point, by Google and by Google Chrome, YouTube, obviously, and a bunch of other products inside that. But Microsoft has said if they can take 1 point of market share, they can add $2 billion in revenue in any given year. And investors are liking what they're seeing with respect to these the OpenAI operability and what it's going to bring to the search engine experience from a Bing perspective. And as a result, they're bidding up the stock. I think Microsoft has overtaken again the $2 trillion market cap level as a result of the moves this morning. And the stock is the highest, I think, since early September. So this is no longer theoretical. This is practical. And I think that is the change that company executives have been trying to articulate to investors for a number of months now, and they're just starting to get traction on it. Microsoft, of course, just a few weeks ago said it was going to cull about 11,000 staff, and it was going to redirect investment to things that they know are going to be profitable. So the company is now directing a lot of that investment into AI. Investors have a great deal of trust and faith in Satya Nadella, and as a result, they're rewarding him for this outlook. He's going to have to deliver on it, there's no question about it. But it is interesting the way in which investors have been giving him this leeway. And as a result, we are switching from that theoretical to practical, and it's being played out in the stock price as a result.
It's fascinating to me, Martin. I mean, I was talking to Dan Ives of Wedbush yesterday, and he said that he thinks that there's a AI arms race playing out between Google and Microsoft so far because of Bard, which is the ChatGPT rival that Google is unveiling. Do you agree with that? Do you think that we're going to see that?
I do. I obviously, I mean, here's the parallel sort of dynamic. Microsoft probably has a head start on Google with respect to the AI development. The ChatGPT that they are embedding into Bing is of a higher level than Bard, at least at the moment. And as a result, it will have slight first mover advantage if it can get traction at the user level. Of course, the flip side of that is Google's dominance in search is so extreme that Microsoft is going to have to do something incredibly special to wean people off of their reliance on the Google Chrome browser. So that will elicit to some degree an arms race. But from a cash point of view, it might not be to the level that maybe would be worrying. AI is incredibly efficient in terms of the gains that it can drive with particular investment dollars. And yes, Microsoft has put about $10 billion in altogether. But when you put that into context in their annual revenue gains, it's not really that significant. And it's not significant in the sense that if it is going to drive a $2 billion revenue gain for every market point of share, then that's a value at 2 or 3 times the price. So an arms race for sure, but maybe not a capital race at the same time. And in either instance, that's going to be good news for the investors to get behind it.
Do you think that all these new investments is going to spark a sector bubble at all?
Probably not. I think that investors have really shifted their focus to companies that are being much more disciplined with respect to costs and respect to their growth ambitions. They're simply not rewarding growth at any cost any longer. And they don't have to do that in a rising interest rate environment because they can look at alternative yields, not only in treasury markets, but in a host of other assets, if they get frustrated with the gains or the lack of gains from some of the tech companies. So you're seeing big mega cap tech being rewarded for that focus on discipline and for diverting investments to profitable enterprises. I would imagine that will continue. So I don't see that as eliciting a bubble to any great degree for the names that we know. It might be more dangerous for companies that are trying to leap into the AI space as part of sort of a FOMO trade. Investors would need to be wary that companies are going to be able to do that and execute properly. But for the larger names, the Googles, the Microsofts, the Apples, the Amazons of the world, I don't see it as potentially bubble creating because I see it as far more efficient and coming in parallel with the new cost discipline that investors really like.
All right, Martin, well, I could talk about AI all day. Let's move on to our rapid fire section.
Let's do it.
And I actually want to start with Uber. How did it impress with its Q4 earnings?
Really big numbers on the ride side. I think ride revenues were up about 82% from last year, and we're getting back to these normal commuting patterns. And we're taking people, so it seems, to restaurants and to airports and a whole host of other places as a result of the travel and entertainment boom that we've talked about for a number of months now. So big gains on the rides revenues, and that drove a top line gain, which topped analyst forecasts. I think the revenue figure was about 8.6 billion, and that was just ahead of the street forecast. Depending on how you measure it, Catherine, there was either a surprise profit for the fourth quarter or a narrowing loss, and it's not worth getting into the debate about the adjustments. But Uber has said it's turning the corner into a profitable company in 2023 going forward. And as a result, that's something that investors have looked for a number of years now, and they're driving up the stock price as a result.
And CVS Health confirmed a $10.6 billion takeover of Oak Street Health. I've had a number of traders here on the floor tell me that they're looking into healthcare. Is this a big deal?
It really seems to me, Catherine, like it's a big one. It's the second major sort of purchase for the company, I think, in about 2 years. It's a $10.6 billion all-cash deal, and it brings Oak Street, which is sort of an operator of care homes around the country, into the CVS fold. And as a result, it gives CVS kind of a two-pronged attack, if you will, actually probably three to some degree, with regards to the potential revenue and earnings gains. It has, of course, the retail division, it has the pharmacy benefits division, and now this healthcare operating division. So CVS is really expanding into a large-scale health services and pharmaceutical company, which is driving significant revenue growth. I think we got to about 83 billion in quarterly revenue, 83.8 if I'm not wrong, in fourth quarter revenue. That was well ahead of street forecasts. And consistent profitability. So CVS is firing on all cylinders. It's using its capital in a targeted and profitable way. Investors like the stock, and I'm not surprised that it's gaining today, even off the back of a big 10.6 billion cash transaction.
And finally, Chipotle. What was behind that December sales slide?
It's hard to say, really. I'm a bit surprised and mystified to some degree by these numbers because store visits were down, but same-store sales were up. And that generally means that margins should improve because the company is passing on higher menu prices to the customers. But the margins were indeed under pressure. So I think that's part of the reason why this earnings miss is being treated with a bit of skepticism from the market this morning. It was 829 on an adjusted level in terms of earnings per share. That was well shy of the 890 forecast and about 2.2 billion in overall revenues. Now, the company has a very good position in the fast food market. They're the third largest chain in the United States. And their customer base, Catherine, is sort of typically at a higher level of income than some of its rivals, and they are able to absorb those menu price hikes. So I think investors will come around to the Chipotle growth story going into 2023, but they probably want to parse through some of the details of the earnings before they do it, and I think that largely explains the share price decline this morning.
All right, Martin Baccardax, thank you, and that'll do it for The Street today. You can stick with The Street for more on these and all of the other major market stories that matter to you, and we'll see you tomorrow.